Hi, and welcome to Midas Investing. Today we're going to be taking a look at Skyworks Solutions, ticker SWKS. Skyworks is a major player in the semiconductor space focused on wireless connectivity technologies, with themselves being a major supplier with major revenue concentrations coming from Apple and Apple-related products. Let's take a look and see what we can find out. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. All right, so right off the bat, I actually wanted to comment a little bit on Skyworks in terms of its relative valuation or its pricing of itself in multiple form against other comparables that you might have them placed against in the market, as well as taking into account a variety of fundamental metrics. I've put together a pricing statistically correlating this comparable group with various multiples, in this particular case being the forward price to earnings ratio, an EV to forward sales ratio, as well as price to book ratios against return on invested capital, gross margins, and return on invested capital respectively. The reasons why we're focusing on those particular metrics just is because those are the ones that have the highest corollary power with this particular method. And we find that Skyworks is significantly underpriced against all three of these ratios and metrics. And if we take a composite of all of the multiples and the different metrics that they can be priced against, we find that Skyworks is more significantly underpriced relative to its comp group against all three of these metrics. So that's just one momentary snapshot. Obviously, we typically like to focus on a longer term intrinsic valuation versus relative valuation. But I think this is at least one thing to kind of show that Skyworks is perhaps in a good position to be rewarded in the short run if we find that the company is to be significantly undervalued and to be a worthwhile investment from the get-go. All right, so hopping right into our spreadsheet, we take a look at some of Skyworks' operating metrics. Here I have their revenue split into kind of two main segments as the way we're going to look at it, which is the Apple revenues here in blue versus their other revenues going back to 2016. And we can see that their concentration of Apple-related revenues has actually only gone up over the last several years, which is pretty crazy to think about, especially considering how much Skyworks has actually expanded their customer base. It's just that they've expanded their customer base in relatively small shares for each of those customers, and while they've expanded their patents and their components that they're selling to those customers, likewise it seems to be in relatively small quantities. I also have here backdrop against that the gross margin for the company, which I'm putting it here partially which is a little bit ahead of talking about the rest of the revenues in relation to the company. But I did find a pretty strong statistical correlation between the gross margin of the company and what share of the revenues are coming from Apple. It's a negative correlation, but it's statistically significant, showing that essentially the more concentration they have towards Apple as a portion of their total revenues, the lower the gross margin tends to be. And that sort of makes sense if you're thinking about it, the one large gorilla player that they are operating with being Apple, having perhaps a little bit more bargaining power when it comes to making deals for their revenues in each given year. And likewise, we flip over to this next slide where we're focusing a little bit more specifically on Apple. Now, my last valuation I actually did was Apple, and I partially did that Apple valuation specifically so that I could do this Skyworks valuation here today. I kind of eventually came to the conclusion that if I wanted to do a Skyworks valuation, which was one that I thought would perhaps have a better opportunity of being closer to fair value or perhaps being significantly undervalued, then I wanted to do Apple metrics first. So if you haven't checked out my Apple valuation, you should probably check that out first. Have it up here on the screen somewhere. But here we have the Apple units being sold by year, according to Apple's data, which we talked about in that particular valuation. And then the red line right here shows the average Apple dollars per unit, which is effectively like a weighted revenue per unit sold for Apple, which is kind of like a weighted average price, but not quite exactly due to the way they defer revenues in some cases. But it's essentially like a weighted average price for Apple. You can see it going from and the 600 and change upwards over the course of the years, upwards towards a little over $1,000 and change in 2023. Now, the yellow line down here at the bottom is the dollars of Skyworks' revenue per Apple unit sold. So this is essentially like, okay, well, how many dollars of revenue are going into the Apple products? And you can see that that has gone from $6 per unit in 2016 upward to $16 per unit in 2023, which, you know, this may seem very small here at the bottom of the screen, but that is almost a tripling over the course of 2016 to 2013. Whereas, for example, the price of Apple products themselves have definitely not even doubled. So you can see there's a significant difference there. Now, this next slide, we're focusing in a little bit on R&D costs and also the various ways of kind of thinking about metrics related to that. This has to do with how we're going to be thinking about the other sections of Skyworks' revenue, the non-Apple portions of the revenue, from which we're going to be focusing on the amount of patents that Skyworks puts out and essentially the amount of dollars that they get relative to the patents and how we think that that relates to the R&D costs themselves. So here we have the R&D costs per year over the course of the last decade, and then backdrop against that, we have the R&D costs as a percentage of their total revenue for Skyworks. You can see that's been pretty snugly and consistently in this kind of 10 to 15% range. It's definitely moved up and downwards, but 10 to 15% is kind of the general range that we see for that. And then as a percentage of the Apple revenue, what I mean by that is the Apple related revenues of Skyworks. So R&D expenses as a percentage of that. Now, the reason why I'm showing it this way is because we're going to be building up our model showing how Apple revenues or come out of specifically the same projections we made for our Apple valuation, but then the other sections of the revenues we're going to be trying to think of as coming out of their otherwise R&D expense, focusing on building other patents related to other technologies and other components for other customers, and then that builds onto their other revenues over the course of the whole decade. And so the way I like to think about this is that the R&D costs that they do with the Apple revenues that they get from that particular customer, they can essentially shows them funneling that towards the building of the relationships with the other customers themselves. So I'm trying to pay attention to the R&D cost as a percentage of not just the total revenue, but of the Apple revenues themselves, kind of showing the way that this has become more efficient over time. And so that ratio dropped from closer to just under 25% for several years, getting to around the 20% mark for the last several years ever since then. And then beyond that, we include some other metrics here just to try to give you a sense of scale for a few other things. Now we have the Skyworks as a percentage of Apple unit costs. Now this is essentially taking the two numbers that we saw in the previous chart, the weighted average price that Apple is selling their products at versus the weighted average amount of revenues that Skyworks gets from Apple as itself. If you take the ratio between those two, that essentially gives you an idea of what percentage of the selling costs of those Apple units is Skyworks making up. Like what percentage of essentially of the sticker cost of an iPhone is the chips inside of Skyworks, effectively speaking. And that has gone from approximately 1% in 2016 to about 1.6% in 2023. So a little over 1% and kind of moving up over 1.5%, but you can see a relatively small percentage of the total cost, which makes sense because obviously Apple's trying to, make big, gigantic profit margins on their iPhones, right? And then we also include a few other metrics just because I didn't have anywhere else to put them in terms of like a percentage scale here on the right axis. So I wanted to show SG&A costs as a percentage of revenues as well here, which has come downward from in a little over 10% to basically hovering around the kind of like 5, 6, 7% mark, depending on the year for many, many years. And then we also have the D&A depreciation amortization, which has stayed between 1 and 2% for pretty much consistently for the whole decade as well. All right, so this last chart here, so I was just saying the R&D costs that we have, we're talking about how that's going to build into the patents, and then the patents themselves are going to build into the other non-Apple revenues. So here in the backdrop, we have the patents that they have had listed per year going back to the last decade, and then we in the orange bar we have a rolling average delta for those patents. This is kind of an incremental average over the course of 3 years on any typical year. How much are they adding to the patent basis? You can see that stayed pretty consistently, just like a few hundred, anywhere from like 200 to 500 per year, but it kind of changes a little bit over the course of the few years that we have right here. And then the lines themselves shows the dollars per patent, so the dollars of other revenues that they're receiving in 2016 per patent that they have in 2016. And you can see that that's come down pretty significantly from a little bit less than $1 million to getting kind of around the $500,000 point, coming down here to about $1/3 coming back towards about $500,000, and then coming back down. So somewhere between $250,000 and $500,000 is kind of where that's been pretty consistently for the last several years. And then this R&D per incremental. Now I showed you the R&D cost on the last chart, and now we're comparing those R&D costs to the incremental changes that we're seeing here. So depending on how much on average that they have on any given year in R&D costs, how much on average do we typically see the incremental change a few years later? And specifically, the idea is how much R&D on average do they have to spend over the course of 3 years in order to see a typical 3-year incremental average in the total patent amount. So the idea is like how much R&D typically do they have to spend in order to get a new patent? That's kind of the idea here. And that line is a little bit more erratic, going from a little bit less than 500,000 in 2014, spiking up pretty significantly to over 1 million in 2016, kind of staying consistently in that range till 2018, jumping down a little bit in 2019, and then taking off a little bit more up towards almost 1.5 million per patent in 2021. This is based off of a rolling 3-year basis, so we don't have it upward to the more recent few years. But either way, it gives us kind of an idea of a trend of R&D costs becoming more expensive in order to get more patents, even though the incremental amount of dollar revenues that they get per patent itself has been coming down, showing that it's a little bit harder for them to expand into the other categories of revenues, despite perhaps wanting to become a little bit less focused on Apple revenues specifically. All right, so now coming over to take a look at the model that we put together for the company. As I was saying, for the Apple revenues, we're pretty much just going to rely on the numbers that we put in our Apple valuation. So if you haven't seen the Apple valuation, you might want to go see it to see exactly how I came up with those numbers. But either way, in that valuation, we had the units being sold in 2020 or 2032 being anywhere from 135 million Apple units to 186 million Apple units in our bear to bull cases. And then we also had the average dollar per unit going from a little bit less than 1,400 per unit to possibly being a little bit more than 1,600 per unit. And so that in right there gets us some metrics to kind of work with for our Apple section of the company revenues that we're putting together. Now, we had seen on those charts that the percentage of the per unit costs for Skyworks relative to the Apple per unit selling price was about 1%, moving upwards towards about 1.5% over the course of the last decade. And so we're essentially going to be relying on a ratio relative to that, assuming that in the bear case, it'll stay where it currently is, about 1.5%. And then maybe in the bull case that trend upward will continue to a little over 2% in the bull case, getting us about 1.8% in the base case. But either way, that gets us something to scale against the average unit cost for Apple to try to figure out exactly how much the dollars per unit that from Skyworks' perspective that they would be selling. 1.5% relative to that just less than 1,400 gets us $21 per unit, and 2.2% relative to the just over 1,600 gets us about $35 per unit. So that gets us the approximate dollars per Apple unit sold for Skyworks' revenues itself. Then if you multiply those by the actual units sold themselves, we end up with 2.8 billion in the bear case Apple revenues and 6.6 billion in the bull case Apple revenues. Now, when it comes to putting together the other customer revenues, as I was saying, we're going to be basing that off of the total patents and the dollars per patent that we think that they'll be able to get. And then we're getting to the patent levels by focusing on the R&D expenses, which we, as I had shown in the chart, we scaled the R&D expenses against their total revenues, but also against just their Apple revenues, taking it as though that the excess cash flow from the Apple revenues are what's going to be paying for those R&D costs in order to develop further revenues with other customers. So with that in mind, I then essentially apply potential ratios. Like we had said, on average, it was about 22% relative to the Apple revenues for the last several years we saw. So I have that scaled anywhere from 19.2% to 22.2% against that, which gets us to about 500 million in R&D expenses in the bear case to a little bit less than 1.5 billion in the bull case, which that itself, we can then use those ratios relative to the Apple revenues to also scale upward to our dollars per or R&D dollars per patent, which gets us anywhere from $2 million per patent in the bear case, keeping in mind, for example, this is dollars spent per patent developed, so the higher number in the bear case makes sense, to possibly 1.8 million per patent developed in the bull case. Putting all those together, that actually gets us up to about 7,800 patents in the bear case, or about 11,200 patents in the bull case, and which all in together gets us on average about 9.6 thousand patents in the base case. Then we found that the revenues per patent had become a little bit more stable for the last several years, but between about $300,000 and $500,000. We're basically just going to be relying on those ratios for 2032. We had seen a little bit of a declining in that ratio for over the course of the whole 10 years, but it had kind of flattened out over the last 5 years, which also doesn't take into account the fact that there would be inflation going on. So me relying on kind of a similar range is essentially me assuming that the decrease in costs would be balanced out by the inflationary pressures over the course of the same decade, which is a little bit of an assumption, but I have to make an assumption somewhere in here. But either way, applying that to our total patent levels, that gets us up to a little bit under 2.4 billion in the bear case revenues for other revenues versus 6.3, 6.4 billion in the bull case scenario, which if you combine those together with the Apple revenues, that gets us a little bit less than 5.2 billion in the bear case, a little bit less than 13 billion in the bull case, a little bit less than 9.2 billion in the base case for our revenue outcomes. Now, I had already said that I was going to be correlating the gross margin relative to the Apple concentration shares. Now, if we can put together our revenue assumptions here, that actually gets us an output for our Apple concentrations in our bear, base, and bull case scenarios, which are a little bit independent of each other. So you can see that's why the percentages don't necessarily relate one direction or another. But either way, we can then plug that into a forecasting on a linear basis, trying to figure out what the gross margins therefore should be under those Apple concentration levels, which gets us 48% in our bear case, 48.7% in our bull case, and 47.6% in our base case. Then likewise, we also had looked at the SG&A cost scaling, which was about 6.1% on average, with a deviation of about 0.5%. And so I'm going to essentially allow for a somewhat similar level there, where we're essentially going to assume the most recent of SG&A costs, which had been a little bit higher than average, maybe a little bit of a deviation above that in our worst case scenario, and then potentially going a little bit under our average for our bull case scenario, and then our base case will be halfway in between that. We use a similar method for depreciation and amortization costs, which gets us 1.1% in our bear case scenario and 0.4% in the bull case scenario. And then that all in together, we can combine the costs to figure out what operating income before R&D costs, because we like to capitalize R&D costs, ends up being, which ends up being a little over 2 billion for our bear case, and a little over 5.5 billion in our bull case, about 3.7 billion in our base case, which equates to before R&D costs capitalization, as I was talking about, which is likely to take out maybe 2 to 3% there on average, would be about 40% in our bear case and about 42.8%, almost 43% in our bull case, getting us a midpoint about 40.5%. All right, now with that, we can come over and take a look at our DCF template here in the revenue tracks. In the short run, we have the revenue expectations well aligned with the analyst expectations, give or take a little bit. In the long run, we have our bear, base, and bull case scenarios moving towards what we have in the model outcomes. On average, them being approximately the same. They might be slightly different by 100 million here or there, or something like that, but a little less than 6.3 billion in the bear case, a little more than 12 billion in the bull case. Come down here, you can see the way those cumulative growth paths look over time, as well as incremental. And then likewise, we can come over to the operating margins, and somewhat similarly, these operating margins have been adjusted for R&D capitalization, whereas what I was showing in the model was operating income before R&D costs. So that's just literally not even including it all together. So these margins are adjusted downward a little bit for that. And then I'm also being a little bit more conservative than my model actually put out in the terminal year, bringing it down by 1 or 2 percentage points more. But that gets us a terminal on average situation of about 36%, where it had been about 38% for the 5 years preceding that, and for the next 5 years, which is the 5 years before that, it'd be about 35.5% relative to, for example, in the last most recent year, an R&D capitalized operating margin they had was 25.6%. So we are expecting them to bounce back up into higher margins in general, and then kind of float downward a little bit again over time. And then when it comes to capital expenditures in general, this is being guided partially by those analyst expectations in the short run. But in the short run, analysts are assuming that their free cash flows are going to be pretty significant relative to their operating incomes. And so in general, we're seeing net de-investment in the first few years. They're really liquidating larger investments that they had made in the past before moving back into a period of relatively high levels of reinvestment before kind of stabilizing in the longer run. But either way, that gets us a free cash flow distribution well situated at the like 1.5 to 2 billion, maybe a little bit higher than that billion range, and kind of like a weighted average period. You can see how the return on invested capital quartiles move over time here, as well as the capital investment quartiles. And then coming over to the discount rates and the terminal growth situation, we have discount rates and growth assumptions that all in gives us an implied terminal multiple around a weighted average of a 12 or so. We see some potentialities for going into the higher level teens, and even some potentiality of it staying closer to the lower levels there. But in general, we're going to leaving it pretty snugly at this kind of middling terminal multiple here, based somewhat upon historical multiples, as well as the comparable group that we were talking about. But coming down, we can see that the way the current value spells out is that the interquartile range ends up being about $95 to $125. That means that out of all the outcomes that we see potentially being viable for a fair value today, about 50% of those fair values fall between those prices. Here you can see the fair value distribution in its total, as well as the expected returns distribution right here. Pretty solid expected returns all in, nothing necessarily super extreme, and the weighted average is not super extreme at all, but nothing less than 5%. And then a decent amount in the upper teens, definitely nothing to sneeze at there. And then last but not least, we can come over and take a look at the summary DCF page, so you can get a quick look at all of the weighted assumptions that go into that. Coming down, as I had kind of already mentioned, we see about 4 to 5% of upside with the current fair value at just under $112, just under 12% expected returns per annum for the next decade, and it's currently trading at the 44th percentile of the distribution that we created. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it for Skyworks, ticker SWKS. We've covered this company several times on the channel before, and it's definitely a somewhat of a personal favorite of mine for a variety of reasons, so I'll probably cover it again in the future. I did take a very small position in this when it was trading at a little bit of lower prices only a week or two ago. Unfortunately, in the time between me becoming interested in it, building this model, and then making this video for it, it's already moved back upward pretty significantly. So I'm probably not adding to it too much more at these current levels, but it is in the portfolio currently, and we'll see, maybe it'll come back down and allow me to add more to it in the future. So I'll catch you all in the next valuation. Bye.